this is Karan from Forex Trading here. I'm just making a quick video today to answer one of the questions we got left in a comment on our video. This is a question about going short in the market, so profiting when the trend is going down. This question actually, it turns out a lot of beginners have. It's a concept that may seem a little bit counterintuitive, a little bit tricky to grasp at first, but it's fairly simple. So I'll just open up a chart here so we can have a look and find out what's going on. So I'll just clean up my chart quickly, sorry. So yeah, one of the fundamental things in any kind of investment, which I'm sure nearly everyone has heard before, is buy low, sell high. That's how you make any kind of profit in investment. You buy something at a price you think is low, you wait for its expected rise due to your analysis or whatever, and then you sell when the price is high. And the difference is, of course, your profit. This is how much you've made. This happens not just in investment, but all kind of business. You know, that's generally how business works. Retailers will buy stock and then sell it for a higher price. That's just business as normal. So the thing that confuses a lot of people is shorting. So that was called going long. So going short is exactly the same thing, but the other way around. So instead of buy low, sell high, you're doing sell high, buy low. So it's exactly the same thing, but just in a different order. You sell at a price that you think is high, you wait for the market to move down, and then you buy back at a lower price. Once again, same thing, the difference is your profit. There we go. So an obvious question which jumps to a lot of people's mind is, how can you sell something that you don't have? So the short answer to this is that you're essentially borrowing the asset, or in this case the currency pair, from your broker, who uses your account margin as collateral for this. This concept has been around for decades now. It originally began with stocks. Investors saw sort of more volatility in markets that wanted to capture down moves as well as up moves. And so brokers saw this as an opportunity to make more money, and so offered these stocks to investors who were looking to short, essentially as a borrow, and then investors would simply return the stock when they bought it back at a lower price and made their profit. Now that's generally how it works for most assets. However, in Forex it's a little bit different. When you open any kind of trade with a currency pair, what you're doing is you're buying and selling simultaneously at the same time. So let's take an example. Let's just say I'm going long, okay? A normal simple long trade. I want to buy this pair, the Great British Pound against the US dollar, now as I expect it's going to go up, for example, and I'm going to sell it later. So when I buy this currency pair, what I'm in fact doing is that I'm buying the British pound and selling the US dollar simultaneously at the same time, so that when I then later close the transaction here at my profit price, I will then sell the British pound and buy back the US dollar to close out the transaction. Obviously the pound will then be stronger against the dollar, which is how you profit. It's this much profit in pips, but I won't go into pips now. We'll explain that in another video if we haven't already. So you're probably wondering the same question. If we're selling the US dollar, how can you still sell something you don't have? It's the same concept. You're borrowing it from your broker, who uses your account margin as collateral. So I'll just go through a couple of examples in short, just to clear that out, so we hopefully draw this concept in. What you're essentially doing is buying low, selling high, buying low. So say British pound, US dollar, I want to sell this. I think I want to go short as I'm expecting the value of this to drop. I sell it at this point. So when I sell the currency pair, I am in fact selling the British pound and buying the US dollar. So then, as time goes on, So I'm just going to go through a quick example just so we can consolidate this idea of selling high and buying low. So we sell Great British Pound US dollar at this price as we feel it's going to make a down move and we want to capitalize on this. So we sell here. So what we're in fact doing is selling the British pound and buying the US dollar. The market makes its move, moves down. We then buy back the currency pair here. So we're now buying back the British pound and selling the US dollar to close out our transaction. So as we've now bought the pound at a lower price that we sold at, we've now profited. And of course the difference in this case pips is our profit. Well, pips times by your point per pip. Anyway, that is your profit. If you have any questions, please let us know. If you feel like I haven't explained this clearly enough, I'll be happy to make another video to sort that out. For any information, just head over to our website. Here you can find out ways to contact us if need be. We're also starting up a personalized education segment. So just, yeah, any questions or anything, please get in touch. Thank you.